After a push from the Finance Minister, Nirmala Sitharaman, the Reserve Bank of India last month had said that all banks must issue fresh retail and MSME loans starting October 1 with interest rates linked to an external benchmark. Now, banks had all sorts of options, but a majority of the banks who have actually announced these external benchmark linked products have chosen the repo rate as that external benchmark. Now that October 1 has come and passed, let's try and get a sense of where each bank stands. As far as our assessment of these banks goes, we have looked at what happens with the home loan segment, because that is primarily where most lenders and most borrowers feel the difference in interest rates. So to get a sense of where these banks stand, let's start with State Bank of India, the largest lender in the country. And according to what State Bank of India has already disclosed, for loans up to 30 lakh, the previous interest rate, which was linked to the MCLR, was priced at about 8.15% annually. But under the new effective rate, which is the external benchmarking rate, that rate has come up to about 8.2%. That's not much of a difference from the previous rate. It's only about 5 basis points, which actually makes no difference to the customers. But how did the SBI come to that rate? That is, it broke up its interest rate into 3 parts. First is the repo rate, which is the external benchmark, 5.4%. Over and above that, SBI added about a 265 basis point worth of spread, which is essentially calculating its operating costs as well as some of the other administrative costs that may be linked to a loan, as well as about a 15 basis point markup, which is linked to the credit risk involved in that loan. So depending on the customer's risk profile, that 15 basis points will change, will essentially come down for better rated customers. Now, let's look at some of the other large lenders in the system. Firstly, with respect to Bank of Baroda, the MCLR rate was about 8.4 to 8.5% for a loan up to 75 lakh. Now, that has reduced or somewhat compared to about 8.35 to 9.35%. Essentially, that 9.35% is coming in because Bank of Baroda has introduced a 100 basis points credit risk premium. So that will change, of course, depending on the credit score of the customer. Similarly, for Bank of India, the rate has gone down from 8.45 to 8.65 to 8.3 to 8.65. So that is a clear reduction of about 15 basis points on the lower end of the spectrum. However, that 8.65% still stays. Here again, they have introduced a credit risk premium of 25 to 40 basis points. That is a range that the bank has given depending on the customer's credit profile. Essentially, 25 basis point works for customers who have a credit score of 760 and above, and then it just keeps coming up depending on the credit score. Let's look at some of the other public sector banks in the system. Firstly, that's Union Bank of India. Here again, between 30 and 75 lakh, essentially loans below 30 lakh, the bank has said it will charge 11.4% fixed rate. But for loans above that value, they have introduced an external benchmark. There again, the effective lending rate has come down from 8.8% to 8.3%. So that's a 50 basis point reduction for Union Bank of India, the higher end of the spectrum. Similarly, for Canara Bank, now the Canara Bank, when it released its statement to the stock exchanges, it said that the interest rate will be calculated on the repo rate plus 290 basis point spread on how it calculates its interest rate. But it did not clarify whether it will be charging a credit risk premium over and above this rate. But just looking at that amount, that's about 8.3% compared with 8.4% that the bank was charging earlier. So there again, the rates have come down. Things will change, however, for private sector banks who have largely been silent in the entire game so far as far as external benchmark linked rates are concerned. Here, we're looking at 2 of the larger private banks in the system, Axis as well as ICICI. In both these cases, as you can see, the effective revised rate is pretty much similar to what the previous rates were. So that is primarily because the banks have introduced a large spread over and above the repo rate. So that's about 345 to 390 for Axis Bank and about 350 to 380 basis points for ICICI Bank. While these banks did not clarify, what portion of this spread is because of administrative costs and what is because of credit risk premium, it suffices to say that the effective lending rate has not changed much, and therefore the banks will be trying to retain that margin. Now remember, this is something that the analysts have been repeatedly pointing out, that as far as private sector banks are concerned, they'll be better at managing their margins than some of the public sector banks in the system. They don't mind sacrificing their margin as far as the lending activity and the borrowing activity in the system takes over again. The largest private sector bank in the system, HDFC Bank, has already clarified that large part of its book is actually fixed rate in nature, and therefore the RBI's new external benchmark linked rate will not apply to that bank. So that is where the entire lending system stands as far as external benchmarking is concerned.